Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Last 27 years of the NBA in the playoffs, when teams were leading by 14 points or more with less than 3 minutes to play, the record was 970 wins against 0 losses. That changed last night at the world's most famous arena. It is now 11:01 a.m. on the East Coast on this May 22nd. By the way, a very happy birthday to Lily Adami. The Lilster turns 25 today. A lot to discuss. By the way, if you have any questions, put them in the chat. Blow up Amanda's inbox because Amanda might be leaving us late next week for maternity leave. Her baby Cece, her husband Danny Diaz, a lot of Dannys in the risk reversal community. So there's a lot going on today. Not only that, Bill Hockman, I don't know where he is. He's like comedian camp or something. So we have somebody who we won't mention because that person wants to remain nameless, sitting in the seat. So there's a lot happening here.
By the way, Guy, for a little fun fact for the folks in the chat or listening, whether you're listening or viewing, Guy Adami and Linda, I'm not going to dox Linda, give her her last name because she doesn't go by Adami for whatever reason. They have a 26-year-old, a 25-year-old as of today, and a 24-year-old.
Ridiculous.
I mean, at some point, that must have been absolute mayhem. You were a big trader on the street. You had all these rugrats running around. This and that.
No, but since you brought this, just goes to show you how life works. Now, every generation has their, and I'm not like trying to get all sort of dramatic here, but our youngest is going to be 24 in September. He was born on September 7th, 2001. That was a Friday.
Yeah.
For those playing our home game, September 11th was a Tuesday. So I worked at Goldman Sachs at the time. I was home because we just had our third child, 2.5 and under. We had 3 kids, and my world and the world of many people was seemingly coming to an end. So it's remarkable how things change at the drop of a hat. Now, going back to when I was born, if you think about 1963, late 1963, a lot of people having the same conversations about the Cuban Missile Crisis and all that was going on. And so I guess my point is the time changed, but the angst that people feel, it changes for different reasons, but it's always there under the surface, Dan.
Well, you remember that line from the Reminiscence of a Stock Operator that I think it's something like speculation is as old as the hills. And, you know, that book, people ask us for books all the time about markets and the like. And that was probably one of the first ones that, you know, when you entered the market, Liar's Poker wasn't even written.
No, I mean, they weren't even playing. Poker wasn't even a game yet.
You know, what's funny? I was with a lot of like a bunch of like mid-20s sort of Wall Street guys or whatever. And they were all talking about, all right, this is a great example. They were all talking about this was one of the first books that they read about the markets. When I entered in 96 or 97, one of the first books I was meant to read about the markets. But Reminiscence of a Stock Operator is basically the true story of the boy plunger. The kid started out as a ticker tape, you know, run over with a ticker tape and this and that, whatever. And he became like this big trader. And they used, it wasn't the actual name of the guy. But there's lots of great stuff there. And you know what? 100 years later, it's literally, if they had said this book was from the 60s or the 70s, you would have believed it, or the 80s for that matter. So great book. We'll put that in the show notes, guys.
Put it in the show. Only the names have changed, as they say. Anyway, so here we are now, 11:05 on this Thursday. So listen, there's a lot to be excited about. There's a lot to be concerned about. So let's take a look at the S&P 500 because we have a long weekend coming up. We've created this little island to the upside with that gap higher that we've talked about seemingly ad nauseum. That happened obviously on the back of the news over the weekend a couple of weeks ago with the China deal or the pause for 90 days. So we've built upon that, but now we're starting to filter back. What potentially could happen, and Carter's not here, maybe we'll address it next week. I mean, there's a chance that we create a bit of an island reversal if, in fact, we were to open lower on any of the now ensuing days, if we sort of traded sideways. There is that opportunity for that to happen. I don't know what it happens on the back of. But what I'll tell you is this. All roads, Dan, are starting to lead to the bond market, which takes us, if we want to put up a quick TLT chart, takes us to this. And more people are starting to come around to the fact that the bond market is a story. As a matter of fact, I think I mentioned it yesterday. I had a conversation with Gary Cohn, or maybe it was, I don't remember what it was.
Yeah, it was yesterday you talked
and
about.
Ray Dalio was speaking after Gary spoke. And he went out there and said a bunch of things. I shared this 1.5-minute video in our chat. I don't know if we can put it up or not. If we can't, we'll put that in the show notes. But his concerns are some of the concerns that we've talked about, that everything, all risk assets, and by the way, Doug Cass talks about this. If Doug is watching, he's nodding his head, I'm sure. David Rosenberg is writing about this. All risk assets to a certain point are built upon or predicated on what's going on in the bond market here in the United States, and also what's going on globally. And globally, you're starting to see yields move up in a pretty meaningful way, and I don't think enough people are paying attention to it.
Yeah, well, it's just the way in which we've gotten to 4.5 on the 10-year, and we're basically this morning at 4.6%. It is kind of shocking, just kind of the complacency that exists. It's also something that Jamie Dimon used that word. I think it was at an investor day earlier in the week, just the amount of complacency. Let's go back to that S&P chart though for a second. Carter often does this work, and I think it's great. He'll show a chart like this, and he'll kind of circle all of the gaps, whatever period, and he'll suggest that almost every gap in the market gets filled at some point. And you could look at this chart and you could say, okay, I see a bunch of those gaps. The thing that's unique about gaps is that you have this, the day before, whether it's up or down, you have a close. And then the just ferocity or whatever the thing that took it up or down is, it was meant to be an impactful piece of news, obviously, right? And if you go back to just, the Monday that we came in and, they roll back the reciprocal tariffs, that was the thing that was freaking everybody out like a month earlier, right? And so you have that kind of stripped away and you have that gap. Now, you look and see where that 200-day moving average is. Why is that important? I don't give a shit. Like, it's just like a lot of other folks are, whether it's algos, whether it's people who've been trained to kind of look at different patterns in this, they're focused on it. The fact that the 200-day is right in the middle of that gap makes it, in my opinion, that much more interesting. Also, if you were to draw a trend line from those April lows, right, you actually are going to be banging up against that. So that's why that's interesting to me. You use that phrase, island top. What would that mean? If
island reversal. Yep.
Island reversal.
Well, let's just let me break it down for 30 seconds. I apologize so an island. So you see that if you look at that little formation of about 9 or so trading days, that gap created this little island. It stands by itself. In fact, for there to be an island reversal, you need at some point for us to open below those levels to create sort of that island by itself. You can visualize what I'm talking about. Now, I'm not saying it's going to happen, but we have the setup for it potentially to happen. And so that's what we're looking at here. Now, if you want to throw, and I'm going to sort of call a bit of an audible here, throw up an NVIDIA chart and let's specifically look at the last couple days of trading, because yesterday, and I want you to if you look at that action yesterday, you remember we talked about an engulfing pattern way back in January when we made a new all-time high and then closed lower and engulfed the prior day. Well, you had the same thing yesterday, Dan. You had a stock that traded higher than the prior sessions, traded lower than the prior sessions, and closed on the lows. That is a textbook engulfing pattern again. Why is that important? Well, the stock has rallied from $90 to about $135, seemingly in an unabated way. And you have earnings coming out, I believe, Wednesday of next week. So I want you to keep a close eye on that, because I think that could loom large next week.
Yeah, no doubt about it. It'll be interesting to see if it kind of stays. You have an inside day, right? So you had that engulfing, like you said, it opened flat-ish. It made that new high in that range. It got lower than the range, and then it closed right at the, it still closed in the range, but today we're inside of that, right? So that is something that's interesting. That's also something that you look at and you see that move higher just to, 10 tradings a day. And then you see that consolidation, some folks will call that a flag. Sooner or later, it's going to break up or down, right? And to your point about next Wednesday, we have earnings. So it'll be interesting to see how that goes. Guy, we often, we miss Liz Young Thomas, right? She has the baby now.
EYT,
Yeah,
Elizabeth
we
Young
miss
Thomas.
her.
Baby's very cute, by the
But
way.
she's very cute. She's still with us in spirit. Her
No,
team still
you
puts
know
out.
what? I'm not sure that's really true.
No, I think so. She puts out this great note, and Mario puts it out for her right now. They're still doing amazing work, and so we are welcoming Liz back whenever she'll come back. You know, she always has a mic here. But in the meantime, Mario has been gracing us with his work. We get a preview of it. You can find it on the SoFi blog. There it is, SoFi.com/on-the-dash money. Guy is shaking his head a little bit.
It's excruciating.
No, I know, but they do great work. All right,
No,
so
and can I tell you something? Mario, by the way, has acquitted himself extraordinarily well. He's been with us since Elizabeth left, and he was great whilst she was with us. So good for Mario, by the way. But let's look at this because I think, again, it looks a little wonky. It's not. Let's talk about this.
yeah, so decoding the markets, I guess that's the name of this report. Recovery Road here. The S&P 500 rally fell short of 6,000. There's nothing really technically significant about the level, but it's psychologically important round number that will probably serve as resistance. Two levels to keep an eye on for support: the 78.6% retracement level at 58.96 and the 200-day moving average at 57.67. If support fails, it could be the beginning of a meaningful move lower for stocks with what has once support morphing into resistance. And Guy, look at there. They have that gap. Now they're using candlestick charts. We were using bar charts. They mean different things to different people, but you get the structure. Talk to me about those kind of retracement levels, because this is something that, folks, this has nothing to do with fundamentals. This is pure price action and pure technicals.
For the Italians out there, you'll be familiar with the great mathematician Fibonacci, and you know they're all different retracement levels, and Mario is tapping into one of these, and you know it speaks to, again, just sort of math, formulaic stuff that armchair technicians like myself will look at. We always talk about the 50% retracement, which makes sense, but there are other ones as well, and Mario points this out. This sort of dovetails, I think, with some of the commentary that we've heard. I mentioned Ray Dalio earlier. By the way, Jacob said he'll put that very short video in the show notes. I think it's worth watching, clearly, because I brought it up. But what he said, what I heard him say a couple days ago, what Paul Tudor Jones said a couple weeks ago, what Steve Cohen, who, by the way, rarely opines about the market, has said. You throw in Stan Druckenmiller, all the names we've talked about. And then you mentioned in the same breath Doug Cass and now David Rosenberg. You know, a lot of people are looking at similar things and coming to the, I think, the same type of conclusion that all the market's done, and it's been a extraordinary rally. I think historical in terms of the amount of S&P points and the duration with which it's done it. But all it's done is got the market from an extremely oversold condition to an overbought condition. Valuations have not gotten cheaper. They've gotten more expensive. And all the things that we've been concerned about for a while now have not gone away. So here we are. And so you draw your own conclusions from that.
Yeah, no doubt. And I think, yes, for this point, I mean, we just went through the charts the way we see them, the fact that Mario sees them this way. I think it's important because technicals are that sort of thing where people place stops at certain levels, you know, in a position. I mean, more frequently, I guess, in indices and the like here, but some important stuff. They're looking at the same gap, the same support that we are looking at. All right, let's talk valuation. This is Mario saying forward 12-month EPS consensus is $273, only 1.2% below the March 31 peak of 277. That's a number that you and I thought should have more downward pressure on it. And I think that will be something that we see, especially if we have a protracted trade war. Even if we leave these 30% tariffs on China, it's no doubt about it. It's going to weigh on U.S. corporate earnings, because at some point, no matter what these CEOs say about their ability to kind of eat a bunch of these higher costs, sooner or later, they either have to pass it through to consumers or they have to start cutting costs in a way that might be disruptive to their businesses. So again, we'll see over the next few months. This is less than in prior periods of non-recessionary market upheaval, such as 2015 to 16, oil shock down 5.7%, 2018 to 19 trade war, and tough Fed. I love that. Tough Fed down 3.1%, and the 2022 to 23 inflation shock down 6%, Guy Adami.
So the third bullet point is where it gets interesting. The risk that the fundamentals break down in the immediate future is somewhat muted. I would agree with that. However, and I think you agree with this and Mario would agree as well, the market's going to sniff that out. So the short-term risks may be muted without question in terms of the economy, but will the market start to sniff out what potentially could happen in the back half of this year? I'll say again, I think those earnings expectations are a bit of a pipe dream, although we had John Buttersworth yesterday that suggested things on the earnings front might not be as sort of dire as I thought. But with all that said, I don't think there's any way we come in at those levels. I think it's going to be a lot closer to 250, if not below it. But then the next question, I think this is where it gets important. If there's a slowdown and if we find ourselves, again, you said this earlier in our podcast, I'll say it again, I'm not an economist, but if we do find ourselves in a recession, the historical norms for multiple in a recession are not 21.5 or 22. If you really average it out, it's probably closer to 15, 15.5. And we've seen a lot lower than that. So the question is, will the market sniff it out? What are earnings going to come in? And what's the right multiple to place on said earnings if, in fact, we're going into the slowdown that I think we're going into?
Yeah. And so Buttersworth yesterday, obviously from FactSet, we were really surprised at how few companies in the S&P 500 had either pulled their guidance or B, had guided down, right? And so what you might see, though, as we go deeper into this Q2, right? And here we are now, we're, probably midway-ish or, almost, 2/3, if you will, by the time we get to the end of next week or whatever, at some point, these companies that actually, kind of put their neck out to say, we're going to have to raise prices. Then they pulled back because the administration got all up in their grill. Sooner or later, if they are going to eat those costs, they may have to pre-announce, guys. Right? I mean, that's something we could see in the first or second week of June negatively. And so at that point, you're going to see estimates for individual companies come down, and then you're going to see that $270 number come down. And I love the phrase that you use, the market sniffing it out, right? That's going to happen if you see one of these big retailers or something like that in consumer tech or whatever. So yeah, interesting stuff. All right, last thing.
Real quick, now, not that I'm pushing back, I'm not. And I agree with you that you should be seeing pre-announcements. The only reason why I think you may not, although they should, is because I think companies will be fearful for the reasons they give and then falling under sort of the lens of an administration that's clearly going to push back and say, things are not nearly as dire. The same way they push back on Walmart, you shouldn't be raising prices. You had record profits last year, billions of dollars more than the market was expecting. So I think it's going to be a very measured corporate America going forward in terms of the language they use with guidance and with earnings releases. That's just me. I just think they want to be very careful going forward.
Except you can't have it both ways, right?
No, I'm not. Listen, I'm not disagreeing with you.
But those CEOs also have a fiduciary responsibility, to their CEOs, and there's a lot of reporting, regulations and the like here. So the last thing that they are probably, I mean, listen, I totally understand what you're saying. I just think that, again, you can't have it both ways. A lot of stuff has happened in a very short period of time. And, we're in a market right now that's kind of waiting for anything, whether it's a tweet, whether it's, overnight vote on a tax bill, whether it's China pushing back on X and such, this sort of thing. I mean, we're in a period right now where I can't remember. I have to go back, guy, to the financial crisis or probably COVID and then the financial crisis where there's so much, balls up in the air where, John Chambers, CEO of Cisco, used to say this all the time. And I really admired the guy, no matter what they printed on the quarter, whether it was a beat and raise, whether it was a missing guy down. Remember, he was always down there on the New York Stock Exchange the next day or calling in and,
questions. Good or bad.
And he used to say this expression again and again that we can, we focus on the things that we can control. And I think what's different about this market environment right now is that if you are a market participant, there's just so many things out of your control. Not that there's ever, any meaningful control that people have from a macro standpoint, but the confidence that you have in companies and their management to do exactly what Chambers used to say. These guys, you just said it. There's things that they should be doing that they're afraid to do because of the fear of retribution. And that's a bad place to be in financial markets.
No, listen, 100%.
Yeah. So
No, I
right.
think we're both saying the same thing in a different way, but I agree. Real quick, well, let's go to the next chart before we do the questions, because I think the next chart speaks about bond volatility, which again, I think we've been talking about for a while. We're going to throw up a 30-year bond chart as well, but let's just take a look at this, because some of the things we've been concerned about, again, I'm mirroring and I'm echoing some of the comments we talked about earlier, are come into fruition. And here's Liz and Mario sharing this chart with us in terms of what 30-year treasuries are doing, what the volatility in the bond market is. And again, it's hard for me to paint a bullish overall narrative when you're seeing bond volatility like we're seeing it yet again.
Yeah, but the way that they're showing this guy is really interesting, because you're like one of the few people that I know that are equity centric, whether it's on our pods, whether it's on Fast Money, that talk about high yield and spreads right here. So what sticks out to me is like, yeah, like we see what yields are doing. We've been talking about it on a daily basis. It's been a sneaky little move back towards those prior highs over the last year. But look at high yield credit spreads. I mean, look where they are relative to where they were a month and change ago when everything was going haywire. And now you have this relative calm, which I think is really interesting. It kind of speaks to the fact that, there's no real, I guess you would call it pressure or, panic in the credit markets right here. So, that's something that is, worth paying attention to, because if you start seeing that one pick up a little bit, then you kind of get to a place where we were in early April.
Well, that goes again, and we talked about this, but it's worth mentioning some of the commentary around Jamie Dimon, some of the comments he made about complacency and his concern about all the risks that are out there. And listen, he has been singing the same type of song now for a while, so maybe to a certain extent it's falling on deaf ears, but it doesn't mean he's wrong. And I think those credit spreads speak to exactly that, just this overall complacency with the market, thinking we're going to skate through this thing again. I am not once again, I am not one of those people that believe that, but we'll see. We talked about 30-year yields. This is the HYG. Let's just put that up. I mean, you can see where we are. We haven't been here in a while, and there's another chart that illustrates exactly the last time we were here, and it was quite some time ago, Dan. It was about 16, 17 or so years ago when we saw these types of levels. Now, again, a lot of people say it's not a big deal. Well, it is a big deal when this specifically, you talk about mortgage rates and loans are built upon what's going on here. So you can see what's happening. And by definition, it means that mortgage rates have only gone higher. And in my opinion, will only continue to go higher, which is going to put a bit of a tailspin and put a bit of a damper on the whole home builders chart. And we have an XHB chart that shows exactly that. We got a little bit of relief when rates went lower on the back of the aforementioned Trump comments around Jamie Dimon and what he saw in the bond market, but we've starting to give it all right back. And I'm of the belief, and I'm not suggesting I'm right, but I think we're going to see those levels that we saw in early April.
Yeah. The home builder thing is important. We have a 7% 30-year fixed mortgage on average here in the US. And, some of the commentary we heard from the home builders wasn't particularly great. I mean, from a technical perspective, you see this thing sort of breaking down. It didn't have the sort of bounce that we had in a lot of other financialized, sectors of the market. And I think a lot of that has to do with the fact that if the Fed is not lowering, the Fed funds rate and the 10-year yield is moving the opposite way, you're going to have a housing market that's just stuck, right? And so this is one, to me, I think you can probably sell rallies. I think that's what's going on right here. And so, we talk a little bit about Home Depot earlier in the week. We saw the kind of reversal off of that initial enthusiasm there. So I'm with you there. The other thing I'll just say is that, the idea, like the recovery road, which is what Mario wrote about, they gave a few different ways how things have calmed down a good bit despite the yield thing. I mean, I don't know. I mean, yeah, things have settled out. But like, if you put together a lot of the things that we've just been talking about with S&P earnings, if you kind of want to be a seller of $270 in earnings right now, if you're focused on valuation, trading on that number at 21.5 times, but you get down to 255 as we get further into Q3, well, then you have a really expensive market, right? If the stock market is just kind of hanging out right here. And so I just think the idea that people think we're out of the woods because we've had that one framework of a trade deal, that's where I think you're doing it wrong right here. Like, that's the thing. Like, this is the time to be skeptical, not back in mid-April. You know what I mean? When all things were going haywire. And so, again, I find the whole situation a little confounding. I will say this though, Guy, we got Memorial Day this weekend. We have Juneteenth on June 19th, which is a Thursday. Then we get into the July 4th. It's going to be a lot of holiday trading. And the only reason I bring that up is that you often will see lower volumes in periods like that or whatever. And, you could say that could be good for markets if we start seeing things come in pretty good. But we're not going to have, Q2 earnings. Really, I'm sure the banks start reporting, July 11, 12, something like that. And then, before you know it, we're going to be in the summer, and who knows what's going to happen. But I think that corresponds a little bit about what you're thinking about S&P earnings estimates.
Yeah, no, look, that adage, you don't short a dull market, it's historically been true, but there's a flip side of that coin as well. And there are concerns out there because, quite frankly, the bond market and the commodities market and the currency markets don't really care one way or another about Memorial Day. Things will be happening. So stay
I'm
tuned.
surprised you didn't say the one of your favorite sayings this time of year about the market. What is it? I've
never used that term in my life.
Go away.
Yeah.
Now I got y'all. I got you.
I mean, a little too. I mean, the Nick game did it to me. Although the Yankees won, the Martian.
Were you yelling at the TV?
No. It's funny you say that, and I'm sorry, Amanda. But just give me a second here. I've been a Knicks fan. I don't remember the '69 World Championship. I was too young. But I remember the team. But I definitely remember the '73 championship, the Knicks, and that was a magical team. And they've been showing. ESPN has been showing a lot about those Knicks teams, which were Hall of Famers galore. I love the Knicks. Something's happened to me over the last 15 or 20 years. I don't have the same passion about the NBA that I used to have. So although I was disappointed last night, clearly, not nearly to the extent that I would have, let's say the Rangers were winning, 4-1 going into the third and lost 5-4 in overtime. That would have devastated me. The Knicks loss aggravated me, intrigued me, but it didn't devastate me. For some reason, I don't know. I don't have the same passion about basketball as I once had.
Do you think the Knicks, if they can win Friday night?
I think the Knicks will be fine. I think the Knicks are going to be fine. If you remember, for you playing our home game, the Reggie Lewis game, not Reggie Lewis, Reggie Miller game.
Did you see his shit-eating grin?
Listen, he hates the Knicks, and I admire him. If I were him, I'd hate him too.
Yeah,
he's entitled to that. But that was game one of that series, which I think, if memory serves, the Knicks wound up winning the series. And this could play out this is a 7-game series. These are two teams that are evenly matched without question. And the Pacers were unconscious in the first half. And it's hard to believe they're going to be able to shoot the basketball the way they did. So we'll see. Listen, I still think this Knicks team is destined for the NBA Finals. But I also think that Oklahoma City is that much better than everybody else. Back to you.
Yeah, just
the way I broke that down. By the way, if you're a Toronto Maple Leaf fan, and now I'm sorry, Amanda, you think I'm miserable as a Ranger fan? Holy shit. The Leafs, again, I got their goaltender got hurt, he got concussed and that, but man, oh man, you're up in that series 2-0 and you lose. And not only do you lose, when you're at home for game 5, you lose like 6-1, and then you get your doors blown off at home in game 7. It's effing embarrassing. They're going to blow that team up.
That's what happened to Rangers last year.
I don't think they got their doors blown off in the
same way.
Yes, I know, but Toronto,
but your point, that team got blown up a bit. You know what I mean? They didn't make the
Ranger team. The Ranger team is it's gonna be a much different. It's not about fighting in the NHL. That ship has sailed a long time ago. But you have to play with a level of grit and nastiness that this Ranger team does not possess. Like, you got to have assholes like me that are just looking to get into the shit. Like a Brad Marchand, who said to him, he has said publicly that if he didn't play the way he played, he'd never been in the NHL. People you just don't want to play against. Those are the teams that you want. Back to you.
Guy,
sorry, Amanda. Sorry, Amanda. I'm sorry. I am sorry.
She's doing well, by the way, guys.
By the way, do we have a picture? Can we? I don't know if we're allowed to do this or not.
Wait, by the way,
picture of baby Cece holding that little chalkboard. If we can put that up, that is so good.
All right, but that's a T-shirt, by the way. Amanda is doing well.
Man is doing well.
That's going to be a great t-shirt. We have a question here, Guy. This
Got
is
Apple, I think.
now. Well, let's start with Lee J. Lee J. Curious what the
Talking about REITs. I know.
Curious what you cats think about buying REITs.
I love that
The
whole
sector has
thing.
been torched the last several years, but it seems like real estate could be in play coming out of this housing rush. That's true. Let's pull up for a second, Guy, before I get your. I can't say I don't know shit about REITs. I'll just be really honest with you. But let's pull up the S&P 500 sectors, and we'll get to the REITs in a second. So if we want to look at the far column, year-to-date percentage change, what I think is interesting here, so, with rates, where they are, you see the real estate select sector. It's basically unchanged on the year, which I think is interesting. And then look at the year-to-date that we're seeing here. So consumer discretionary, that makes some sense to me. It's just kind of fascinating that one of the worst performing sectors is healthcare, right? You know what I mean? And then energy makes some sense to me, but everything else feels pretty green other than discretionary. Thoughts on REITs if you have
we don't look at them enough. And as you just said, I'm not going to pretend that I know a lot about them. I'm not going to wax poetic, but what I will say is this. If you think we're headed into the environment that Dan and I have been talking about for a while, if you think interest rates are going higher, there's going to be a slowdown. The unemployment rate's going to continue to, not continue, but start to move up in a interesting or precipitous fashion. It's very hard to make a bullish argument for REITs in this environment, despite the fact that, as Lee mentioned, they've sold off. So I am not particularly. I think there's something called the ALPS Active REIT ETF. I think it comes out REIT, and that's from memory. I don't know. I mean, that might be something to take a look at. I don't know if Jacob, Amanda, Timmy, Bill, anybody else, or Cece can throw it up, but I am not, just because they've gone lower doesn't mean they're attractive, in my opinion.
Yeah. All right. Our main man, Doug Cass at Seabreeze, writes for thestreetpro.com. Doug. All right. He just sent us this tweet, and this is a really funny story. All right. Will you, Jacob, please put this up. All right, Guy, look at this guy's handle and tell me if you know who this person is, because you see it? His name.
I don't see anything yet.
All right, come on there. Come on.
Oh no, we're putting. I mean, Jacob loves hanging us out to dry. I love this. Like, Jacob is. You remember in Mission Impossible?
Which one?
The one with John Voight, and
the very first one. The very first.
Was that the first one? But he's just waiting. He's just waiting. Like, he's waiting to sort of give them the okay, and he's just playing with them, and that's what Jacob's. Cuppy. Oh, we know this guy. This guy. I mean, this guy came to dinner with us in Florida 2 years ago. He's
Cuppy. He's
an odd cat.
He was odd. So Porter Collins met him on the internet, as one does. I'm sure they slid into each other's DMs. So if you can. Yeah, if you look at the hat, this is his little thing. It's make volatility great again on a red hat. Okay, so Porter.
There you go.
Yeah, Porter and Vinny have been saying that, and I love this. I mean, listen, he is. They say he's a brilliant guy. I don't know him, but look what he's saying. This guy makes zero hedge sound bullish. This is Jamie Dimon. I mean, that's funny stuff. So he's probably
that is funny stuff.
I'm not on the Twitter, so I can't tell you if it's good or not. That sort of thing. So Doug, thanks for.
By the way, Jamie should button this. I mean, who is he? Fucking Engelbert Humperdinck with that shirt?
I think he's a stud.
Come on, button your shirt. I mean, honestly, God.
Well, you don't say that to me when I have my shirt. Like when I have last night, I was at dinner and I didn't even realize this. I popped the button. You know what I mean? So I was showing. I was like a little like this. It took me a little while to figure it out. All right, let's go to that Apple question really quickly, because this is
what's the deal with Apple? I mean, what's the frequency, Kenneth? And this question is Ethan Lip. That's a new name. Hello, Ethan. Apple chart. Any thoughts? Yeah, I mean, we addressed this in our podcast that dropped earlier, but we'll address it again. I mean, clearly Apple has got themselves in the crosshairs of a lot of different things, not least of which this administration. And I think, again, they have they clearly have a problem on the AI front. I think they've basically thrown their hands up in the air and said, okay, you developers out there, you help us figure it out, which I don't think is particularly bullish. And I think they have a valuation problem. And this, by the way, is a stock. A lot of stocks traded through the 200-day moving average and went flying through them. Microsoft at the top of the list. This is one that went through it on the downside and got now not anywhere close to it on the way back up. So, you know what I think. I thought for a long time we'd revisit those June levels. We did in early April. The bounce has been interesting, but not, I don't think, all that dramatic. And I think we're headed lower.
Yeah, it is the worst performing Mag 7 stock. It's down nearly 20% in the year. Tesla's down 17%. It was down a lot more. Tesla had a big comeback. I think Apple has a different problem, Guy. I mean, I agree with the Apple Intelligence. We know that June 9th, they have this Developers Day. You just mentioned that they're putting out this developers kit, and hopefully they're going to get a little help from them as it relates to services and AI apps and the like. But, iPhone units have not been growing. I mean, this is the big problem, right? This is the thing that's 55% of their revenue. If you don't sell more iPhones with better performance than this like, then services are going to fail. China has been a huge part of their sales, apparatus over the last 10 years. China is weakening dramatically for them, right? And then the reshoring and all this sort of stuff. But they got a problem as it relates to consensus estimates, because right now, we're looking at for this year, and we're halfway through it, their fiscal year, mid-single digits EPS growth. That's not happening. I mean, I'm not an analyst who covers this stock, but there's nothing good going on for this company. And then next year, you're looking at 10% expected EPS growth. That's not happening. I mean, unless they have some hit, right, with Apple Intelligence, they finally get the thing out. And, 4% expected sales growth this year, next year, the year after. I mean, the best days for Apple stock are probably over. Yeah, they generate a shit ton of cash and this and whatever. If they don't have any new product hits, and they're starting to lose some of these key, demographics, or some of these key geographies, sorry about that, you know what I mean? Then they just have a real problem here, because this is, it's a discretionary device at the price, but it's become a staple. And a staple to me is less interesting for a product company. Do you know what I'm saying? Because you're not running out to buy the next one immediately.
So I agree. Put up the XLK chart, which I think is going to look eerily similar to the S&P chart. And let me opine for a second about Apple. When Apple was a growth stock a decade or so ago, maybe longer than that, it was trading at a value stock valuation, was trading at a low teens valuation, which didn't make sense to anybody. Now that it's become potentially a bit of a value stock, it's trading in terms of a growth stock valuation, which equally doesn't make sense. And I think what Apple has won to, and what they will continue to win to unless something happens in the broader market, is the fact that they're in over 400 ETFs, of which they're one of the top 15 1-5 holdings. So passive investing is Apple's best friend, and that's not going to change unless something happens in the broader market. And you can see how quickly things can change on a dime in terms of the fate of Apple. So I agree with everything you said. I mean, if you just looked at it in straight valuation, it doesn't make any sense. But passive investing helps them, but we'll see how long that sort of crutch stays with them.
All right. So Apple, you and I both don't like. NVIDIA.
And here's the XLK. So that looks like the S&P chart. Sorry.
Yeah. No, I mean, it's obviously outperformed the S&P off of the lows. All right. So you don't like Apple. NVIDIA is a wait and see until next week. Microsoft, let's pull up Microsoft. I'm just going through the Mag 7 for a second here, guy. Microsoft, we talked about this over the last few days, is getting back towards those prior highs. That quarter was a bit of the impetus, I would say, before it breaks out of this long base, and you can call whatever you want. It looks like a base to me, right? Over the last year, I think you probably have a check back towards that 200-day moving average. It's got a lot of the same issues that you just mentioned about Apple. In my opinion, they have the potential for having an AI problem too, especially if this OpenAI relationship starts to unfold a little bit. Yeah, they can license Anthropic or, some of this other tech, but I think the valuation, I think, how they're positioned in AI, I think they're going to have a massive long-term opportunity once there's a general appreciation in the enterprise for these tools. But right now, I don't think they're getting the sort of, like return on investment. So I don't find Microsoft, the ability for it to break out and establish a new range above that red line, I don't think is particularly great. Do you have any other view on Microsoft, like pushing back on anything I just said?
It's gotten itself expensive again, valuation wise. It's been an underperformer until the last couple of weeks since last July. It's, as you just mentioned, it's trading back to levels that we saw last July. That's either going to be great or very problematic if, in fact, we get there and fail. I mean, it's not cheap by any stretch. I agree with you. And there's a lot listen, the fact that we went blowing through the 200-day moving average in a way that a lot of other stocks or indices did not is encouraging on the one hand. It could be frightening on the other because, any hint of bad news, I think it's going to give the entire thing back. Before we get out of here, real quick, this is a name we talk about from time to time. Snowflake, one of everybody's love childs for a while, an extraordinarily volatile stock, gapping higher today. But the question is for those folks out there that are long this, what do you do now? And if you look at this chart, I mean, we're at these levels that, has been a bit of a problem. We'll see if we sort of fill that gap that was created. I want to say in January in the spring of 2024 or something like that. If we were to fill that, which we're probably close to, and fail, that's going to be a problem.
Yeah, this is a tough one. I mean, this is one that was being very underappreciated as the generative AI plays, the hyperscalers, and NVIDIA in particular, were raging. And I think a bit of that move to that gap was probably saying, okay, how are these guys positioned from a big data standpoint? And it just wasn't showing up in their numbers. And I think a lot of people wanted to believe about a broadening out, right, from the hyperscalers, from some of these other semi names. And I mean, not only did that not come to fruition, a year or so ago, year and change ago, but look at how the stock kept on making lower lows. And so here we are, we had that gap from, the late fall. And, it was one of the first stocks to kind of fill in one of those massive gaps and head towards those prior lows. So, I'm not obviously chasing anything like this. One name though, I want to go back to that Microsoft chart because you said something really interesting, guy. You said the way in which it broke out above that 200-day moving average. And, we just talked about the potential for a check back to that. Here's a great example of a name that did exactly that. Let's pull up Amazon's chart for a second here. So it gapped up on earnings above that 200-day moving average. Okay, so it looks in some ways kind of similar. It's still well off those recent all-time highs, but look how this one checked back to that 200-day. So it's filled in a big part of that gap. And I just say that support better hold. Andy Jazz, excuse me. Andy Jassy, the CEO of the company, was out this week saying that they're not seeing a lot of pressure on the consumer and they're not seeing price increases. I think it's really important to remember 60% of the items sold on Amazon are coming from third-party sellers, okay? So they can't control, this is Amazon, right? What third-party sellers, how they price their things. Go on Amazon and search for something that you buy frequently, and you're going to see all these weird prices for one good. You know what I mean? I know you don't buy on the line, guy, but like it's really interesting how some seller in Minnesota could be charging, $3 more for a bar of soap than what Amazon does because they source it the way Walmart sources the products or this and whatever. But a big source of their this is great margin for them when they have third-party sellers and they're just doing the logistics for them. They don't have to warehouse any, like all that sort of stuff. I mean, they do warehouse to some degree, some of that stuff, but again, this is one, I don't know how Andy Jazzy's coming out and saying that, given all the uncertainty, given how much of the product that they source comes from China. And I think it goes back to what we were talking about 15 minutes ago. I think a lot of these CEOs don't know which way this thing is going.
It's very Brian Moynihan-ish of him. And yes, the next thing I buy on the line probably will be the first. I just don't like doing it. I like going to my local merchants and having conversations with the people in produce and stuff. That's just
the mom and pop
bank and
the mom and pop
stores. I think that might be it for today.
Yeah, that's it.
Because, I'm sure people are tired of listening to us opine. Long weekend coming up. We won't be back we'll be somewhere on Monday, but we won't be doing market call. But I promise you we'll be doing it on Tuesday of next week. Dan is sitting down with Mike Wilson, our quarterly segment with him from Morgan Stanley. That will drop tomorrow. That will be a must listen without question. Packy McCormick conversation dropped today of the not boring or so not boring or little boring or
just not boring. It's just not boring. That was, listen, you and I get to meet and talk to a lot of interesting people, whether they're market people, whether they're in industries and the like. Packy's a guy that I met 4 years ago, and he was writing a lot about Web3. He wrote a lot of influential stuff about Web3. He wasn't like one of the cheerleaders of this or whatever. He did deep dives on stuff, and I think it was really helpful to a lot of people on the way up and on the way down. He's doing a lot of work right now on disruptive technology, and he's so thoughtful. I could have literally talked to him for 3 hours, you know what I mean? But we had to cut it at an hour. So check that out. That's in the feed today. And one last thing, if you have questions that you want me to ask Mike Wilson from Morgan Stanley, email them to amanda@riskreversal.com, and I'll try to get a few of them in there, because I know a lot of you guys see him. He's written up on CNBC and on Bloomberg and all the time. Every Monday when he puts his note out, he's on. He's going to be on CNBC tonight, actually, for the full hour. So give us a couple questions, and happy to kind of relay those.
Blow the shit out of Amanda's inbox without question. I guess we didn't want to put baby Cece's picture up, but it is fantastic. It's adorable. I guess we don't want to dox her. Let me say this to our audience. A bunch of you are coming to the June 5th Fast Money event. Thank you for that. We look forward to that. And thank you. We've now got up to 115,000 YouTube subs, which is, thanks to you, extraordinary growth. So as we get into Memorial Day, we thank you for everything. We try our best, right, wrong, indifferent. We're still going to be putting it out there every day. So Dan, enjoy that conversation with Mike, and we will see you folks next week.
See you guys.